Bond markets heard me call for a rally, and they were like, yeah? Well, what if I just went ahead and dropped another rate hike right here? Bah! Let's break it down. So before the market opened, we saw those bond yields jump up. What that is confirmation that there could be a fourth interest rate hike. Now, we also saw lots of headlines, lots of people saying, oh, the Fed needs to really slam down on these inflation numbers. But we've gone over these inflation numbers. It's something I've covered, and it looks like it's starting to peak out. Now, we're going to need confirmation on this next month. We'll get some more data points, and then we'll really see how this is really playing out. But in January, there's nothing really notable that was really like signaling like this will continue to be an issue. And supply chains are kind of finding their groove, and we need to be a little more patient here. What I'm seeing is maybe a little bit more psychology rather than fundamentals is at play. Now, we still have lots of bearish headlines. The main thing that has my attention right now, more than this inflation distraction, which I think is fear and people not being transparent about their short positions, so they want everything to come down, but is that Ukraine-Russia conflict that's mid-January to mid-February. Now, this is from the White House. This is the official White House statement. Mid-January to mid-February is our most volatile period. Most of that's probably playing into the fact of, like, is Russia going to keep over 100,000 troops at the border of Ukraine indefinitely for training practices? Probably not. So if they're going to make a move, they're going to make a move soon. And so we can kind of anticipate that. You know, I'm hedged out for that. I'm just being leery of the situation. Right now, those hedges are playing out great because the market's melting down. And of course, that's from those bond yields coming up. That fourth interest rate is now being confirmed by the bond market. Of course, that's just the market's anticipation. It doesn't mean it's guaranteed. If we start to see inflation numbers actually start to come back down, we'll need to react to that. And remember, if inflation does stay persistently high, inflation is an inflating of asset prices. Stocks are always traditionally the best hedge against inflation. You know, this is why years ago the government incorporated 401ks and gave you the Roth, so because they knew that your wages would not keep up with inflation and markets. So you would need to hedge yourself against stocks, and these different packages are made for that purpose. So to sell off out of fear on long-term positions purely because inflation does not make sense. Now, how you position yourself could be important, and we're kind of seeing some of that rotation. A lot of people are excited about some bond trades that they're going for, and I'm just kind of taking a seat back because I feel like we've kind of decoupled from fundamentals, and we're kind of playing with psychology now. I think that's why you're starting to see people come out like ultimately bearish right now. You know, the calls for the Fed to do dramatic interest rate hikes so that they can slam this inflation and, oh, the virus is still really bad. You got to worry about, you know, this is really decoupling from the fundamentals at play. You know, even if we get those 4 interest rate hikes, this is still relatively low. The bigger fear there, of course, is the fact that if they actually raise the interest rate hikes, that they'll actually do some damage to the economy, some real damage that the economy can't handle. That's the bigger fear there, not the fact that, you know, we'll see some monetary tightening, which means it's more expensive to grow. You know, those will take a toll and we will see sell-offs, but that's not alone what could crash a market. It's that extra fear of like they can't do it because the system can't handle it. So that, let's just be clear on, that's the portion of the conversation that's causing all the fear that's really accelerating right now. But for me, what is causing my fear is the global macroeconomics at play. Well, more of the political side of that. And actually, let's touch on the global macroeconomics for a minute when the China conversation, because honestly, I feel like the Chinese stocks are actually, you know, I don't like to admit this, but it looks like a pretty good time to go long. These look like they've kind of bottomed out. And if China's giving a bunch of stimulus and stuff, I have to admit that these do look like a good opportunity. if you want to ignore the fact that you're investing in an opponent of America who's doing a bunch of, who's violating a bunch of human rights, who is debated on, their involvement with the original COVID outbreak, who is messing with Africa trade routes, messing with 1/3 of the world's trade routes, setting up military bases around them, aggressing towards Taiwan, aggressing towards India. Well, if you want to ignore all of those ethical and moral issues, which I would not recommend, then it looks like a great entry point. And that's the disclaimer that I don't see enough big hedge fund managers talk about. I don't know if these people get too caught up in the numbers and they forget about their humanity, but I just so polar to that mindset, and it's very upsetting to me. I would love it if the government was like, no more Chinese investments, banned, and the tech war is on with China. It's not war. The tech race is on with China. I would love that, because if you think about it, the likelihood that we go to war with them after you declare an outright this is a tech race decreases a whole lot. You set an objective. You set your objective and automatically set China's objective. The objective is not war. The objective is an economic race. A race will win. A race that I'm very confident that will win. The China bulls, I haven't heard one argument to convince me of otherwise. And I've heard a lot. I've dug deep. And I haven't heard a single argument that makes even slight sense to me. And I've covered this over and over and over. I mean, all those issues that we just covered, they've been repealing the more capitalistic policies, incorporating more communism, jailing CEOs, and making it disappear for months at a time. Like, how's that bullish? Like, they're looking at numbers that aren't audited. They're not confirmed to be real numbers. We don't actually know what it actually looks like, but we can see bonds constantly default or get downgraded, and the real estate market fall apart. So which is a 2% of the GDP loss. Their GDP estimates just dropped to 4%. They're behind us. Of course, our estimates are also looking pretty bearish as well. Forward-looking estimates, but I think those could also be an under or an overestimation of how low it will go. We'll need to see that play out. I could be wrong on that, considering in times like this, there's so many moving parts and so much going on. It's really ill-advised to get in a rut of like, this is what's going to happen. There's too many factors right now. There's too much going on, especially when you span out from the U.S. and you start thinking about global markets. That's when it really becomes a murky waters to delve into. That said, I do feel like we're starting to get close to a bottom, bar one of those bearish headlines, an invasion. We don't really know how the market will react to Russia invading Ukraine. To me, the more black swan event would be China making a war move, and I just still stand behind. Call the tech race, announce it, ban you investment in China, cut off a huge supply of their monetary investments, and make those investors invest in U.S. companies, invest domestically, help build our supply chains here, help build our production here, help us. We need help right now. And for everyone, especially hedge fund managers, to be telling everyone and all this retail money, it's like a third of the market that you're constantly telling, like, China's gonna blow up, China's gonna do great. It's like, based on what exactly? Because they brought more communism. Because that hasn't worked for decades and decades, and that's why they've always been behind us. But now suddenly it'll just work. Does it make sense? Because it doesn't make sense to me. So let's go ahead and step away from that, kind of talk about some specific companies. Goldman Sachs missed earnings. They had a sell-off. I'm kind of expecting this to kind of ripple out to some of these other brokerages who are likely not doing well. Their investments probably, especially if they've been long on the markets, it's hard to do well on, large portfolios that just need to buy stocks and have to worry about liquidity, moving around and navigating. is pretty difficult. That's the main advantage you have as a retail trader. And let's be clear about that. As a retail trader, you could be infinitely flexible. You probably rarely have to worry about liquidity. And this allows you to have so much more flexibility in how you can maneuver yourself through different market environments. So those with you with small accounts, rejoice, because you don't have to worry about stuff like that. So Goldman Sachs missed earnings. I'm kind of expecting these other brokerages to maybe be in some trouble. I would love, Robinhood's at a point I can't justify shorting it anymore, although I am still really bearish on the company. Because I'm expecting a lot of these retail traders, a majority of them, to feel burned from the markets, to either move to different platforms or just step away at all from investing, especially those who just dove straight into options, and which is a large portion of people, and way over leveraged themselves into these markets. I don't know if they'll come back. One of the things we saw after the dot-com bubble, where you also had that surplus of traders, as soon as the markets crashed, we got bearish conditions. I mean, there were several years where there wasn't much liquidity in markets and participation going on. Brokerages hated this time period. Remember, people like TD Ameritrade, they still make money off your option trades. Okay, they charge a small portion for each contract both ways. So that's a portion of their income, and with so many participants trading in the markets, that's extra profits for them. If we see a big sudden drop off in that because people don't like this bearish market, they just aren't trading, or maybe they pulled out completely. They look at these stocks are still relatively high even after some sell-offs. And so Goldman Sachs, that sell-off from them wasn't really a surprise to me. Was it exaggerated? Probably. We're still talking about, a huge bank brokerage and investment teams. Although the CFO did come out and said he was looking for some talent. I went ahead and tweeted at him. I was like, hey, I'll train your new talent. But that's one thing that's really, I think I've mentioned this before, but that's one thing that's really on my mind. And then we're looking at, we have Netflix earnings later this week. And when you're looking at where the stock is, I had some people tweeting at me saying, oh, would this be a good point to go bearish? And I'm looking at the sell-off where the stock's been. Yes, we did see them increase prices, which would make me feel a little bearish. But the thing is has this stock already kind of anticipated that move? There was a previous earnings. I don't want to say it was the last earnings, but there was an earnings before the earnings. They came out and they said that we've incorporated new technology to prevent people from sharing their accounts. That was really bearish headline. That was a really bearish headline because you don't worry about stuff like that until you're having trouble pushing new profits. Or new highs on your profits. That's something you worry about when growth starts to slow. So if that growth continues to slow and they started raising prices, it could be bearish. But when you look at where the stock's at, we're still talking about the most dominant streaming service who could pivot in all sorts of ways. I'm actually shocked. And I'm so shocked that this company has not tried harder to branch away from just streaming. Years ago, Scott Galloway was a big advocate for this too. I thought them buying Spotify would have just been a goldmine decision. I thought that would have been so great, especially since those companies align so well on their ideals. And the way they handle content on their platforms, it would have been a nice fit. And I was shocked. They never made a move like that. They really haven't tried to position away from that. Maybe this starts to actually hurt them, especially as Disney starts to incorporate more into their shows, and Apple's starting to pick up the pace, and Amazon, is doing stuff. Roku's doing stuff. I'm not sure if that's really notable yet. It's not anything that's really caught my eye. And Amazon's so big, you're just investing in just a giant conglomerate. You can't really make a play on Amazon just because of their streaming service. And Apple's kind of getting to the point where you kind of have to have that same sort of discourse in your head when you're kind of analyzing that, because there's so many different parts of this company that it makes it harder to make a sector-specific play with them, because you're factoring in all the pieces of this company, and you're talking about one that isn't the major income or revenue-driven can I put words together? Main revenue driver for that company. So I think because Netflix likes to move, it could be a contender to play both ways, or it might just be a good time just to sit back. It'll depend on how much those premiums look like coming in close to the earnings. The thing is, I could anticipate big volatility drop-offs, or if markets stay bearish or we get some political move, we could see volatility maintain high throughout earnings season, which actually makes these earnings plays kind of juicy when you think about it. That's your number one thing. When volatility drops off after the earnings call, you'll see a large depreciation in the premiums of your option contracts. So even if you get the move you want to get, you need to have that move justify that premium drop off from the volatility drop off. If volatility overall stays high though, and we won't be able to really measure, you got to measure different sectors, okay? So you can't look at a banking stock and say, well, it stayed relatively high and then assume the same will happen for tech. Different factors at play, right? So different factors also in how people are positioning themselves in these type of market conditions. So when we're talking about that is kind of the things you want to analyze. I'm not making any estimations yet. I've not made any moves yet, but I am keeping an eye on that because it's an interesting conversation to have about that. And remember that earnings plays, we don't all in earnings plays. We don't go big on earnings plays, but it's just a nice way to get a nice boost. It's been maybe a very, very small portion of your already should be small play money. Or if you're just starting out, please don't do wild bets like this. If you have a small account, you're trying to grow it up, do not worry about earnings plays. This is for people who have a small portion of their options account that they want to allocate towards it. And I'm talking like the 1% of the 1% of your account and you put in the earnings place. Got it? Good. See you hopefully tomorrow. I'm already working on a big historical macroeconomics analysis to kind of play out what has led us to where we are in the modern day, all the way back before World War I. And then so that people can get a better understanding of where the globe is now. And then I want to do a video hopefully next week talking about the paradigm shift that I think we're undergoing. And I'm going to do another deep dive in China. So get ready. Are you excited? I'm excited. See you on the next episode.